With the Nasdaq down over 12% year to date already, just 1 month into the year, there are a few mega cap stocks that are presenting us an interesting opportunity for long-term investors. Now, as per the dictionary definition of this, a mega cap company is one with over $200 billion worth of market cap. So obviously the list of companies that qualify here isn't too extensive. And what I want to do here is actually a few separate videos, this one covering mega caps, but then maybe a few more covering large cap, mid cap, small cap companies, do kind of a full series on this if that's something you guys want to see. And if it is, just drop a like on this video, comment down below, and let me know. This is typically information that I'd share like inside my VIP group with some research that I do and kind of like narrow down a short list of stocks that I'm interested in watching. So I'm sure you guys are going to find a ton of value in this video, so make sure you stick around. Okay, so let's go through this list here. Let's kick off with an obvious stock that a lot of you guys are probably watching and maybe some of you are even starting to buy right now, Amazon. So currently Amazon is sitting at around 25% off of its all-time highs, bringing the stock below $3,000 per share for the first time in almost about a year. This 25% dip is quite rare in Amazon, as we've seen during the COVID crash. This stock only declined around 25% back then, and before that in 2018, it was a 37% dip. So a 20% correction like we're seeing right now only happens every couple of years or so, so it's definitely worth watching. Now, on an EV to sales metric, this is one of the metrics I actually like using for a lot of stocks out there, Amazon is trading at a valuation that it was at prior to the COVID crash, even though the company now has meaningfully increased value since 2 years ago. Now, for reference, Amazon is expected to pull in over $500 billion in revenue next year, and the last time we saw this valuation, it was pulling in just over $300 billion in revenue. So here we have a classic case of a company that has improving fundamentals, but the stock price kind of goes nowhere for a period of time. It even drops to prices that we haven't seen in quite a while. And these are the times you really want to be looking at strong, stable companies to really beef up your portfolio with. Now, I'm not going to tell you if this is a buy or any of the stocks on the list are a buy. You kind of make that decision for yourself. But I think it's pretty compelling from some of the stats that you're going to see today that these stocks are showing some good value. Okay, now let's move on to kind of a pure play giant in the tech space that I don't see talked about too much on YouTube. That's Adobe. Adobe is another huge company here, down big and nearly 30% off of its highs that it hit just a few months ago. Historically, this sort of selling is not something this stock sees very often either. And when it does see it, it averages around a 25-35% drawdown. And currently, guess what? We're sitting smack dab in the middle of that. Now, this doesn't mean that we can't go any lower in the stock. Of course, anything can happen here, especially if the broader market sells off. But what this signals to me is that there's potentially a really good entry point here to start accumulating shares. Now again, jump back to our EV to sales multiple, Adobe isn't quite as cheap as it was pre-COVID, but this is an example of a stock that could have been re-rated higher thanks to the efficiencies it realized from COVID. This company has become much of a better business. We can see here from a free cash flow standpoint, Adobe accelerated this growth and is now pulling in nearly $7 billion a year in free cash flow versus only about $4 billion prior to COVID. So now, all things considered, to pay a forward multiple here of around 13x, it doesn't look too bad considering the stability, the free cash flow generation, the growth, and just the overall moat that this business has out there. It is compelling. Okay, so moving on, another pure software play that I find very interesting, Salesforce. Salesforce is another giant that provides consistent returns over the long term and is a pure SaaS play. Now, this one is also down around 30%, similar to Adobe, but Salesforce actually corrects more often than Adobe. And apart from the COVID crash, around a 30% correction is right about where we'd expect Salesforce to come down to. Now, from a valuation perspective, this has contracted back to pre-COVID multiples, and honestly, for a giant that's growing 20% a year, a 7x multiple is very fair. Now, the absolute dollar amount free cash flow for CRM isn't as high as Adobe, but it's also clearly a strong cash flow generator, and it saw its growth pick up since 2020 and should keep improving for many years to come now, especially since they've acquired Slack as well. So far, the stocks that we've seen have contracted their multiples pretty close to where they were pre-COVID. Some are even at where they were pre-COVID. But here's a stock that I'm about to cover that actually has its price come back to pre-COVID levels. Disney stock is back to under $140 per share. It's down 32%, and it seems to be an overlooked name here. During the COVID crash, it corrected nearly 50%, and we're not much higher than that today, guys. And considering where other stocks have gone in this time period, this is one to look at here for a possible retracement back to all-time highs quicker than some other names. Remember, prior to COVID, Disney was just kind of launching the Disney Plus platform. There was still a lot of, how successful this is going to be. Hopefully things work out. And over the last couple of years, they've proven that they are growing rapidly. So now you have a business that's priced about the same prior to Disney Plus. So it's kind of hard to argue that you're getting some great value here. You're essentially getting a Netflix type business within Disney, but you're only paying the valuation for its traditional things like, the studios, the parks, etc. Okay, so this next one and the one after this, they're kind of a bit more controversial, but they are mega caps and they are showing value, so I got to cover them. Alibaba here has corrected 66%, and this one's been kind of a long, painful drawdown for quite a while. It's corrected well before these other stocks, but nonetheless, the metrics for this company are just way too appealing to turn a blind eye to, so it's definitely worth at least considering. You can see here that the multiples for Alibaba have absolutely collapsed, sitting at a 2x now, and it may still be early to call a bottom in the stock, but it seems like things could be turning around for Alibaba in 2022 as China seems to be easing their previous crackdown measures. They're cutting interest rates. So there's a lot of tailwinds that this company can actually see here, which could help its valuations come back to where it was like a year or two ago. Now, I've made a ton of videos on Alibaba, so I'm not going to go too much further into the stock, but it is definitely one worth considering. And I totally understand if this is not a company that you're interested in. Maybe this next pick will interest you a little bit more. Facebook or Meta is probably the cheapest tech stock out there. It's down 23%, and this is a volatile name because it's seen multiple 20% drawdowns in recent years, which have all turned out to be buying opportunities in hindsight. Now, what's interesting with Facebook is even though it grows like 20-30% a year, it still has a very cheap price to sales multiple of around a 6x currently, and it has a cheap PE as well, guys, of around a 22. This stock is currently priced like it's a boring retail name, no growth ahead of it, but in fact, it's actually one of the fastest growing big tech companies and one of the most profitable companies in the entire world as well. Facebook generates over $20 billion of free cash flow every year, and that's money that's left over after all their expenses are paid, and this is something they see every single year. So this means that it's an extremely safe and lucrative company to invest in. Now, what we've seen recently is Microsoft make a massive acquisition of Activision Blizzard, and I think that Facebook may be looking to make a massive acquisition of itself as well. I also think the other big tech giants are probably looking at companies to buy, but Facebook here just has so much cash on their balance sheet, they need to deploy that somewhere, especially now when valuations have contracted and their business is still thriving. Now, will the deal pass with regulations and all that kind of stuff? That's a different story. But I think this company has a long runway of growth ahead of it, and at current valuations is very attractive. Now again, I want to reiterate that these are not buy recommendations, these are just some ideas thrown out there for mega cap companies. Now, if you want to see me do a similar video on large cap, mid cap, small cap companies, let me know in the comments. I may have to break those down into multiple videos because there's a lot of stocks to cover in there, but I also do think that there's a ton of value in those smaller companies because those got beaten down the most so far, and when they do recover can provide some life-changing returns over time. But either way, I think all these companies on this list have a good shot at providing us a nice 10 to 20% return annualized for the next 3 to 5 years, possibly more than that. And I'm actually a fan of all companies that I listed here today personally. But anyways, guys, hope you enjoyed this video. If you did, again, hit that like button. Thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.